In this video, we will talk about the sell or short trading rules. It is just a mirror image of the buy or long trade rules. Let us start with the principles of consistency. The first principle of consistency is to objectively identify our edge. Just like with the buy trade rules, we will have a simple, easy to spot but most importantly, objective and specific rules to define and identify the edge or trading signal. This is a trend-following strategy, so the first thing that we need to know is to identify the current market trend, market condition, or what is the current market phase. We need an objective process of identifying if there is a trend, or is the market consolidating, or ranging. And based on that analysis we can easily decide on what will be our bias. Step 1. Identify the current market trend using the Ichimoku indicator. Decide our bias. One rule of thumb for this strategy: if the market is touching the Kumo, or trading inside the Kumo, for me, it is an indication that the current market condition is in range, and in consolidation. If this is the case, we will not look for a trade. If we are looking for a short or sell trade, this is the step-by-step process in identifying a trend to the downside. If the current price level is trading below a bearish Kumo, and not touching the Kumo above, and if the Tenkan Sen is below the Kijun Sen, and if we have a bearish Kumo, the trend is down and bearish, our bias is to sell or go short the market. We will look for a good price level to sell the market. Step 2. We need to see if the market recently created a series of lower high, and lower low, and breaks below the initial low. A market that breaks down below a ranging, or consolidating market, or printed an impulsive move below the Kumo is also valid. You will see an example of these in the actual back-testing process. This is a basic price behavior to start a trend to the downside. The guiding thoughts behind this concept: we need to see a market that is already trending lower. Let's find out if the market recently created a series of lower high, and lower low, and breaks below the initial low. We have the initial high here, and the initial low here. Then the market pulled back, and created the lower high, and moved to continue to the lower low, finally, breaking below the initial low. We just confirmed a valid lower low, and lower high market movement below a bearish Kumo. Step 3. We need to see the market to pull back, and close above the Tenkan Sen. Shortly after that, we will look for the entry signal. But first, let's proceed with step 3, and wait for the market to pull back. Let's proceed. Now that the market pulled back, and closed above the Tenkan Sen. For step 4, we will now look for our entry signal, a bearish inside bar, that is also a swing high, and not touching the Kumo above. This is a bearish inside bar, and this will be our entry signal. The mother bar should be the swing high, and in some cases, the mother bar and the inside bar has an equal high, and that is still a valid signal. If we confirm the high of the mother bar, and the inside bar using the price label tool from the drawing panel, we can see, in this case, the mother bar is the swing high for this pullback. Keep in mind that the Tenkan Sen should be below the Kijun Sen, and the current price level, or the candlestick's high, or wick should not be touching the Kumo above. And we should have a bearish Kumo. The principle behind this strategy: this pullback is the short-term uptrend. If you look at the lower time frame, this move is trending higher. And this strategy aims to go against this short-term uptrend, looking for an elegant entry in favor of the long-term trend, which is downtrend. In this scenario, the inside bar is our elegant entry. It is objective, simple, and specific. We now have a valid signal to sell or go short the market. Before we proceed, pause the video, and take time to study, and remember the specific rules and detailed information about this bearish inside bar candlestick pattern. We will use this candlestick pattern throughout the testing process. We have objectively identified our edge and confirmed that we have a valid trade. The second principle of consistency is to predefine our risk. In trading, an edge is just an indication of a higher probability of one thing happening over another. Nothing is certain in trading. We do not know if this downtrend will persist, and if we have a trade running, we do not know the outcome of that trade. We have a probability that suggests one thing will happen over another for a given sets of variables. The market could continue to push down and break the most recent low, or it can go up and change the downtrend to an uptrend. In the market, anything can happen. We need to protect our capital. We can do that by including a stop-loss order to our market order. First, we need to calculate where our stop-loss will be. And we can do this objectively with this simple three-step process. Step 1. Find the highest ATR, average true range, value between the mother bar and the inside bar. We will use the higher ATR value. Focus your attention on the average true range value at the data window while I hover my mouse cursor on these candles. The ATR of the inside bar is 0.0045 or 45 pips. And the ATR of the mother bar is 0.0047 or 47 pips. The mother bar has a higher ATR than the inside bar, so we will use the ATR value of the mother bar. Step 2. Find the value of the swing high. We can simply use this price label tool from the drawing panel, and as you can see, I have already used it to find the high of the inside bar and the mother bar. Or we can look it up again at the data window. The value of the swing high at 1.34300. Since we are selling the market. For step 3, add the ATR value to the swing high. The high of the mother bar at 1.34300 plus the ATR value at 0.0047. And this will be the stop-loss price at 1.3477. Now, let's execute our order perfectly, just like what we did with the buy trade. Let's proceed with position sizing. If you have watched the buy trade rules, we will use the same position size. And if you can remember, I exposed 2% of my equity in this main trade. Our total equity is $10,000, and 2% of that is equivalent to $200. Now, let us execute our order. Pressing F2 to call the order pop-up window. Make sure that the calculate with risk percent is checked. And we will risk 2%. We are going to sell the market. And our stop-loss price at 1.3477. Let's review our order. 2% risk. Sell trade. Stops at 1.3477. The distance from the entry price to the stop-loss price is the risk. It is equivalent to 2% of our total equity, or $200 in monetary value. If we are wrong with our analysis, and the market continue to push up, we will be taken out of this trade automatically, and we will lose $200 plus the spreads and swaps. But our total capital will be protected, and that is the main purpose of this stop-loss order. I am assuming that you have watched the buy trade rules video. If you can remember, now that the risk is on, our job changed from being a technical analyst to a risk manager. Next on the process is to plot the Fibonacci retracement tool. This is my different approach to managing the trade, our risk, and our profit-taking scenario. In my opinion, this method is more conducive to my main goal as a trader, and that is to make money trading the market. Let's progress. Let's plot this Fibonacci retracement tool from the open price to the stop-loss price. I have already explained how I personally use this tool. But just to review, these are not the normal Fibonacci levels. These levels are my own customization. Now, let's edit the tool at the exact open price and stop loss price. The exact open price should be at price 1, at 1.33830. And exact stop loss price should be at price 2, at 1.34770. Click Apply when you're done. Let's build our initial profit and loss scenario, keeping in mind the right mindset that is more conducive to a profitable trading. If the market continues to go up and hit the stop loss price, we let it be. We will not touch it nor move it. We must accept that trading is a risky business, and we will take a loss from time to time. Our mindset shift should be defensive. Cut the losses immediately, and we will not hold on to this trade. In trading, we need two levels of belief. At the level of one trade, the market cannot be predicted. The distribution between wins and losses is random. But at the level of a series of trades, we must firmly believe that whatever it is we are doing will make us money in the long term. Now, if the market continues to move down and hit the 300 level, we will move the stop loss price slightly below the break-even line depending on how much swaps there is. Then, if the market continues to move down and hit the 500 level, we will move the stop loss price to 300 level at the exact price indicated by the Fibonacci tool. And we will continue this process as long as the market continues to move in our favor. Our mindset shift should be offensive, and we will follow the market trend until it stops us. Let us review these Fibonacci level. The distance from the open price to the stop loss price is equivalent to 1 risk. And the distance from the 300 level to the open price is equivalent to 2 risk. And the distance from the 500 level to 300 level is equivalent to 2 risks. We will trail our stop loss price, equivalent to 2 risks behind the current price level. In doing so, will give us an advantage to avoid those big swings, letting our winners run by riding the trend, and giving us more profit from our trade. Let us proceed to the next process of the strategy, adding to a winning position. I have already explained the psychology behind this idea in the last video, as well as the advantage of adding to a winning position. It just boils down to this: if we want to make big money, we need to be able to add to our winning position. Controlling our mind to be able to execute this idea will take practice and patience. Here are the rules of adding to our winning position. We will only add to our position if we have that first position established and currently running a profit, proving in that moment we are right with our speculation, and that the right mindset must be offensive, and we will exploit that move and keep adding to our position. If the market goes in our favor and push the price lower and breaks below the most recent low and close below it with a strong bearish candle, this bearish candle should close below the most recent low. We will add to our position with an exceedingly small stop loss, just 10 pips above the high of that candle, this time with a bigger position size of 3% from our total equity. I have proven this repeatedly, that if we are right in our speculation, we will go against human nature and not take a limited profit. Instead, we will push our winners going in offensive mode and take more profit as much as we can. However, this idea is still bounded by a rigid rules and money management procedure that we will never break. Let us progress and see what happens next. Okay, the market pushed the price lower and closed below the most recent low. Let's do an objective analysis if this trade is valid or not. As you can see, the market continues to go down in our favor, breaking and closing below the most recent low with a strong bearish candle, indicating a strong momentum to the downside. This is the most recent low. And this bearish candle breaks and closed below the most recent low. And if you check at the trading panel below, we can confirm that the first position is currently running a profit. In conclusion, making this trade valid and legible. Our stops will be 10 pips above the high of that candle, and we will expose 3% risk from our total equity. We will now add to our position. But first, let's predefine our risk, and calculate where our stops will be. By using this price label tool, we will find the high of this candle. The high of this candle at 1.33610. Plus 10 pips, which is 0.0010. And this will be our stop loss at 1.3371. Now, let's execute this order. Remember that all the trade in this strategy is a market order, and not a pending order. Press F2 to call the order pop-up window. Make sure to check this Calculate with Risk Percent checkbox. We will risk 3% on this trade. This will be a sell order. And this will be the stop loss price for this trade at 1.3371. Let's review our order. Then click Sell. Part of our capital is now exposed on the market. We are now a risk manager for this trade, and we will use the same method we did with the first position. Let's plot our Fibonacci tools from the open price to the stop loss price right here. And we want to be as objective as possible, so let's edit the exact price coordinates. The exact open price at 1.33160. And the exact stop loss price at 1.33710. Now, let's build the initial profit and loss scenario for this trade. If the market price level go up, and hit the stop loss for this trade, we will be defensive in our mindset, and we let it cut automatically. We will not move the stops or hold on to it. And if the market proceeds in our direction, and hit the 300 level, we will move our stops slightly below the break-even line, keeping in mind the swaps at that moment. And if the market continues to go lower, hit the 500 level, we will move the stops from break-even line down to 300 level. And we will continue to trail our stops to risk behind the current price, just like our first position, following the trend until the market stops us. Let's review our chart. This Fibonacci level is for the first position. And this Fibonacci level is for the second position. Both positions are still at risk. Just like in the buy trade rules video. From this moment, I need you to be aware of the thought process running in your mind. And make sure that you are in the right mental state, a neutral state of mind. I also need you to take your journal, and write your current state of mind, and emotional state. This habit will be valuable in the long term. Being consciously aware of your state of mind is the first step to becoming consistent. Let's proceed, and see what happens next. Okay, since the market price gap down, on this candle, both levels were hit for both positions. The level 300 of first position were hit. And the level 300 for the second position were also hit. But let's focus on the first position. This is the initial stops trailing scenario. If the trend persists, and the price continue to go down, and hit the 300 level, we will move the stops slightly below the break-even line. And as you can see, we now have $8.82 for the swaps. Just drag down the stop loss of the first position and give it 103 points to pay for that swaps. Next on the process is to build a new scenario for the next level. If the price continue to go down and hit the 500 level, we will move the stop loss to 300 level at the exact price as indicated by the Fibonacci tools. Then, we will mark the next level with this ray line. The next level will be level 500. If you can remember from the last video, we need to edit the description and the exact price coordinates of this ray line to match the exact price at the level 500. The description should be, for position 1, move the stop loss to level 300 if price action hit the 500 level. And the exact price should be the price indicated by the Fibonacci at level 500, which is 1.30070. The same goes for price 2. Now, for position 2, we will do the exact same thing we did with the first position. Let's begin with the initial trailing stop scenario. If the market continues to go down and hit the 300 level, we will move the stop loss slightly below the break-even line, and we will consider the current swaps at $9.90. Just drag down the stop loss for position 2. Make sure that you're choosing number 2 stop loss, as the number 1 stop loss is close to number 2 stop loss. We'll give it 116 points to pay for that swaps. Then, build the new scenario. If the market continue to go down and hit the 500 level, we will move the stop loss to 300 level at the exact price indicated by the Fibonacci tools. Now, let's plot the ray line at the 500 level. Then make a description and edit the exact price. The description should be, for position 2, move the stop loss to 300 level if the price action hit the 500 level. Now, for the exact price of the 500 level at 1.30960. The same goes for price 2. And we're done with position 2. Let's just do a quick review. Position 1 is now at break-even line, and the next level will be at level 500. Position 2 is also at break-even line, and the next level will be at level 500. Let's continue. This is a trend-following strategy. From a technical analysis point of view, as long as we have a valid trend, going through all the rules of identifying that trend. If a new signal appear, we will objectively analyze that signal, and if it is valid, we will take that trade, even if we still have an old trade running. Remember that the right mindset to a profitable trading is to keep adding to our winning position. Now, let's do the process of analyzing the trend. If the current price level is trading below the Kumo and not touching the Kumo above, and if the Tenkan Sen is below the Kijun Sen, and if we have a bearish Kumo, the trend is down, and our bias is to sell or go short the market. Let's check if the market is making a new lower high and lower low. The initial high here, initial low here, lower high here, and lower low here. Finally, breaking and closing below the initial low here. We can confirm that we have a market that is continuously making a new low. If the market pullback and close above the Tenkan Sen and give us an inside bar for our entry, we will not hesitate to take that trade. Let's just delete these drawings and proceed with our trade. The market is starting to pull back. Okay, so the market continued the trend, and printed a big bearish candle to the downside. The current price level is here, and as you can see, we just hit the level 500 for the first position. For the meantime, let's do the first position. First, let's read the description on the ray line at the level 500 of the first position. It says here, to move the stop loss to level 300 if the price action hit the level 500. All we have to do is to modify the stop loss for position at the trading panel below. Choose ticket 1. Then right-click to modify the order. The new stop loss should be the price of level 300. The level 300 at 1.31950. Then click Modify Order. Now let's build the new stops trailing scenario for the next level. If the market continue to push down, and hit the 700 level, we will move the stops from level 300 to level 500 at the exact price as indicated by the Fibonacci tools. Time to edit the ray line of the first position. Then, let's update the description and the next price level. The new description should be, for position 1, move the stop loss to 500 level if the price action hit the 700 level. And the new price level should be at level 700 at 1.28190. The same goes for price 2. And as you can see, the ray line moved from level 500 to level 700. Now, let's focus on position 2. This is quite complicated because of the big bearish candle that hit level 500, and then closed below the level 700. The description of the ray line says, for position 2, move the stop loss to level 300 if the price action hit level 500. Here is the current price level. But since the market jumped through level 700, we will move the stops directly to level 500, and not the level 300. We can simply do that by choosing ticket number 2 at the trading panel below, and right-clicking the Modify Order. This is the price for level 500. The new stop-loss price directly at level 500 at 1.30960. Then Modify Order. Next on the process is building the new scenario for the next level, which is at level 900. If the market continue to push down, and hit level 900, we will move the stop loss from level 500 to level 700 at the exact price as indicated by the Fibonacci. Now let's edit the ray line's description, and next price level for this position. The new description should be, for position 2, move the stop loss to level 700 if price action hit the level 900. And the next price level should be at level 900. The level 900 at 1.28760. The same goes for price 2. Then click Apply. Let's continue with our trade. The market seems to continue the downtrend, and this bullish candle hit the level 900 of position 2. Now, let's read the description of the ray line of position 2. It says here, to move the stop loss of position 2 to level 700 if price action hit the level 900. We can do that by simply right-clicking ticket number 2 at the trading panel below, and navigate to Modify Order. The next stop loss level should be at level 700. The price at level 700 at 1.29860. Next on the process is building the new stops trailing scenario. Remember that we will follow the trend until the market stops us. If the market continue to move down and hit the level 1100, we will move the stop loss from level 700 down to level 900 at the exact price indicated by Fibonacci. Then, we need to edit the ray line and update to new description and the next price level to follow. The new description should be: for position 2, move the stop loss to level 900 if the price action hit level 1100. And the next price level should be at level 1100. The price of level 1100 at 1.27660. The same goes for price 2. Let's continue with our trade. Okay, so the stop loss for our position 2 was taken out by this bullish candle, and we were able to follow the market down to level 700. We will do a quick review of this trade at the end of the video. For the meantime, let's proceed with our position 1. Since we won't be needing this, we can delete the ray line of position 2 to clear the chart. After that brief pullback, and hitting the stops of our position 1, the market continues to go down, hitting the level 700 of position 1. Now, let's read the description on the ray line. The description says, for position 1, move the stop loss to level 500 if the price action hit the level 700. Let's modify ticket number 1 at the trading panel below. The new stop loss should be at level 500. And the price at level 500 is 1.30070. Now, let's build the new stops trailing scenario for the next level. If the market continue the trend lower and hit level 900, we will move the stops from level 500 down to level 700 at the exact price as indicated by Fibonacci. Then, let's edit the ray line's description and update the next price level. The new description should be: for position 1, move the stop loss to level 700 if price action hit the level 900. And the next price level should be at level 900. And the price is 1.26310. The same goes for price 2. Let's continue. As you can see, the market continues to go lower. And this bearish candle hit the level 900 of our open position. Now let's read the description on the ray line. The description says, for position 1, move the stop loss to level 700 if price action hit the level 900. Now, let's modify ticket number 1. The new stop loss should be at level 700. The level 700 at 1.28190. Next on the process is building the new stops trailing scenario for the next level. If the market continues the trend lower and hit the level 1100, we will move the stops from level 700 to level 900. Now, let's update the ray line's description and new price level. The new description should be: for position 1, move the stop loss to level 900 if price action hit the level 1100. And the next price level should be at level 1100. And the price at 1.24430. The same goes for price 2. Let's proceed. As you can see, the market pulled back, all the way above Tenkan-sen. Here we have a market that is trading below a bearish Kumo. And this market is not touching the Kumo above. And the Tenkan-sen is still below the Kijun-sen. And we have a confirmed bearish Kumo. From this strategy's perspective, we are in a downtrend, and our bias is to sell or go short the market. Then, let's confirm the recent market movement. Here is the initial high, initial low, lower high, lower low, lower high, and lower low. Breaking and closing below this most recent low. And this low right here. And we have this confirmed closed above the Tenkan-sen. If the market give us a valid entry, we will not hesitate to take that trade, and sell the market, expecting it to move even lower. Let's just remove this drawings, and continue with our trade. Okay, I think some of you will ask if this is a valid trade. This is an inside bar. But the swing high for this pullback is this bearish candle right here, making this trade invalid. And we have to follow every rules of the strategy to be a consistently profitable trader. Let's continue. Okay, the stop loss for our position were hit, taking us out of the market. By this bullish candle, we were able to follow the trend, down to level 700 of position 1. Now, both of our positions were taken out, but we have a good run, and a good reward with this trade. If we did not let our winners run, and added to our position, or set a limited profit target and take just 1 or 1.5 reward, the trade would have ended a long time ago. Yes, the process was repetitive and monotonous, but like I said before, this is a truly profitable trading. Let's just do a quick review of this trade. Let me just drag down the statistics window. I know this is just one trade, but the key to making money trading is the perfect execution of this one trade, over and over again. Now, for our trade review. For the first position, we made 2R here, 2R here, and another 2R here, for a total of 6R, multiplied by 2%, giving us a total gain of 12% for this trade. Now, for the added position. The added position was taken out here. We made 2R here, 2R here, and another 2R here, for a total of 6R, multiplied by 3%, giving us a total gain of 18% for the added position. The swaps for the first position at $40.95, and $46.20 for the second position. These swaps were automatically deducted from our profit. Technically, we should have a total profit gain of 30% for these trades, but because we're paying for the swaps and spread for these two trades, we have a total profit gain of $2,912.25. On the next video, we will do a formal backtesting of this strategy, on Euro US dollar daily chart. We will do a sample size of 30 trades or more. To conclude this video, remember that all we need to be a moneymaker in this business are these: a positive expectancy system with simple and objective rules, a rigid money management rules, a guiding thoughts, or the principles behind the strategy, and finally, mastering your psychology, such as the proper usage of fear and hope, letting your winners run, cutting your losers short, and adding to your winning position. If you like the video, give it a thumbs up, and consider subscribing to the channel. I'll see you on the next video. Thank you for watching.